Hello. I know it's a shocker. I'm here, and we have some stuff to talk about. Price action is getting juicy. Finally, something's happening. Let me put on the music. Let's get in the zone. Talk about things. Oh, come on, come on. There you go. All right, cool. Let's go ahead and switch over. Long time no see, my friends. How we doing? It's been a while. It has been a very long time. I apologize. I got very sick last week. I got a really bad case of strep throat, and even still, like my voice isn't still 100% normal. It got to the point where I can barely speak. So it didn't make sense for me to live stream, and I know I've been trying to hold myself a little more accountable to stream more often, and I apologize. It just seems like every time I want to stick to something, something comes up. I'm not trying to make excuses. I'm just letting you guys know that I'm trying my best to be consistent. Luckily, we didn't miss too much until what's been going on in the last day or so, which is very exciting to talk about because we had a couple different options on the table of what possibly could be going on or what the possible outcome of this pullback could be. And you know, let's talk about those options first. Let's see. Odin, what's up? How you doing? Dylan, Smoke, how you doing, my friend? Good to see you. So pretty much, let's go back and zoom out a little bit and talk about this area here. Talk about the possibilities, what is going on, what the next move could be, what to look out for. But you know, just kind of erasing everything off the chart, starting from scratch. You can see when I zoom out, this, all right, throughout this entirety of this uptrend, you can possibly make an argument for this here, but this is possibly the healthiest correction I've seen in Bitcoin since then. So this is something that Bitcoin actually really needed to kind of sustain a healthy uptrend. But the question is it over yet? Is it done? Where can price go? What's the next step? And we can kind of get the gears turning and start talking about what the possible plan of action is going to be. Because, you know, I can't sit here and say exactly what's going to happen. But what I can do is come up with a plan, trade the plan, and basically work off of what price is giving us. That's the most important thing. So yeah, let's go ahead and start off. So starting off from the peak here, all right, we have a very nice, clear, concise ABC. All right. To me, this is a very, very textbook setup, I would call it. Something that I would consider a very serious point of bullishness / bearishness. Once that we actually put in multiple lows below that pivot. So to me, this is going to be a very, very strong potential bullish reversal if this is going to be a longer term continuation of the upside. So just keep that in mind. All right, around that 60K region. Oh, that's a very bright green. That's still a bright green. That one's fine. All right, it's around 60K. So we have that pullback ABC with an actual smaller ABC within the C. So to me, this is a clear, concise, borderline textbook setup of what I love to see. You could go down and try to chase the long on the lower pivot around 59,000. I'm not the biggest fan of that one. I mean, you could, just because it's so close to each other. If it was a little bit more of a distance between the two, I would consider taking the smaller entry. But since they're so close, in my personal opinion, I probably would set up my trade something like this. Or maybe like a 4%, 3% stop. And just, to me, that is a new all-time high trade, possibly larger continuation higher. So that's how my ideal setup would be if this is going to somewhat turn bullish in the near future. We have to talk about the other option, which I know you guys don't like to hear, or you guys don't want me to talk about sometimes. David, I have a question about Bitcoin. Absolutely, ask away. Jan, how you doing, my friend? Good to see you. It's good to see everyone here. Let me just make sure I have the full chat up. Let me just pull up chat separately. When Satoshi created Bitcoin, was it already in the Lightning Network? No. From what I know, the Lightning Network was a fairly new thing in the last like 4 or 5 years. If someone correct me if I'm wrong. I got the ETH ABC. Awesome. L87. Yeah, we'll definitely talk about that. But could someone confirm that? When it started, did it begin outpace the end? Well, with the Bitcoin mining, or what are you exactly talking about? Like transaction speed? If you're talking about mining, or like basically how much Bitcoin was created, yes, that's how it always was. In the beginning, there is a large amount of Bitcoin being distributed through mining, and as time goes on, the distribution gets limited, gets cut in half not cut in half, but the amount of Bitcoin mined gets cut in half every 4 years. So there's less Bitcoin being distributed into the market every day. If that's what you're talking about. The mining and the creation seems to be similar to the former. I don't think so. No. Because remember, when Bitcoin first came out, right? There was no Bitcoin in circulation. The reward pool for mining was a lot higher. I don't even remember what the original reward pool was for every time you solved an equation for Bitcoin. But it was exponentially higher than it is now. And you create supply and demand. You create the demand by cutting the supply of something. So over the course of every 4 years, the reward pool that was, I keep saying pool, but the reward that was granted or gifted every time you solve the equation to whatever the equation was, the puzzle, as what people like to call it, gets cut in half every 4 years. The circulation started with a reward pool that started, not ended. Why would it focus this way? Well, because it's because there's a finite supply of Bitcoin. I don't know why it was that way. Instead of maybe a steady distribution, they went a lot heavier. There was a lot more distributed in the beginning than now. But what happened? The effect of that is that it creates a supply shock over the course of time. And the people, 21 million, yes. There's a fine after that 21 million mined, there can never be any more Bitcoin created. But the last actual Bitcoin that's going to be mined isn't going to be mined for like another 100 years. So we're all going to be long gone by the time that happens. So that's the reason why you get the value at Bitcoin what it is now, because of supply and demand. And the people, it's a free market that determines the price. Okay. Let me know if you have any more questions. That's a great question. I'm not an expert of the fundamentals of Bitcoin when it comes to the actual blockchain stuff of it. I know the basics, but we're here to talk about price action. But definitely, that was a great question. Now, yes, 21 million. So going back to what I was saying before, we do have that bullish setup. Now, what gets interesting is this. Okay, we have a pocket of support area that we were holding for a very long time. Right, and you guys know me. You guys know how I do things. I look at things from level to level. Right, I'm not looking for exact targets. I'm not looking for a specific number when it comes to anything where price can retrace to, where price can extend to, targets, etc. It's a little bit different once we get above all-time highs, because we don't know where the next area of resistance is, so we can kind of try to use Elliott wave, Fibonacci, and kind of use that to give us an idea of where price can go. But when it comes to retracing and finding support, the best way to do it, in my opinion, is to look at things from a level by level perspective. Right. So the lowest area of support was here. Okay, I'll draw another line for the ABC here. Okay, so now we have this little pocket of support. Now that we broke 58K, we have to look back at the previous trend and let price show us where it can go. All right. So just looking back at this trend here, the way I like to look at things is from a local low perspective. If you guys don't know what local lows are, basically when you have an uptrend, right? Local lows are basically the most recent support pivots that you find during an uptrend. All right, so in this case scenario, this is a local low. All right, this is a local low. This is a local low. Just to make things a little bit easier. All right, so we talked about this local pivot that we broke. So we have to look back in the trend. The next local pivot is here. So for me, around this area, around 50K. So my personal opinion, if price cannot regain the bullish area of this previous ABC that we talked about, right? We can easily go down to 50K. Now, the question is 50K strong support? Possibly. I think it's more of a zone, because you do have this kind of local low combined with a previous high here that kind of gives you a nice little pocket of support. It's not the strongest in my opinion. I would personally say that 38K is probably the strongest area of support below 50. But like I said, it's a level by level basis. Let's see. If you buy Bitcoin at an all-time high like this and I don't have 60K, can I share one with a couple other people and maybe buy like 10,000 worth? It seems like a lot to buy all at once. Well, it's the beautiful thing is you don't have to buy a whole Bitcoin at once. You can buy fractions. So if you want to buy $100 of Bitcoin, you can buy $100 of Bitcoin. If you want to buy $236, you want to buy a very specific amount of USD to Bitcoin, you can. You don't have to buy. It's not like a stock where you have to buy one share at a time. You can't buy fractional shares of a stock, but you can buy fractions of a Bitcoin. So you don't need 60K. You don't. You could buy, $500. You could buy $200, $100. The truth is that going to make you a lot of money? No. If you're looking to make a lot of money out of small stuff, you gotta kind of shoot for the stars and look for coins that have higher potential gains in the future term or in the longer term. That for me, I call those like Grand Slam plays, or something that has potential exponential growth in the longer, I would say medium to longer term time frame. It's probably going to be, for me, this is my Grand Slam coin, my home run coin. It's going to be KDA. What coin do you recommend? Like I said, I personally, this is not financial advice. Okay. The truth is, the time to make a lot of money just by buying Bitcoin is out the window. The last time to do that was back in the previous bull run. All right. Luckily for me, I was here at that time and I did very well. Was back in this area. I bought a lot of, not BTC, but I bought a lot of coins. The BTC was at like 7-8K. You just got to look for coins that have smaller market caps that have the potential to grow exponentially. Like I said, me personally, my personal play, I'm not recommending anyone do this. Do your own research. There's plenty of good information out there about KDA. One of the things that I personally liked about it is that it's kind of similar to Bitcoin in a way, where there is a finite supply that I know of, unless I don't think it's changed over the last time that I checked. It's been over a year since I really looked into the fundamentals of KDA. That it's mineable just like Bitcoin itself. Throughout the entirety of the bear market, all right, I have previous streams to look back at this, and you guys can check if you want. But back during the previous bear market, KDA was the only profitable coin to mine throughout the entirety of the bear market. And if you take potential market caps that it could go to, multiply it by the potential supply at the time, this is a long shot. Don't quote me on this, but it has a potential to get anywhere from $100 to $300. All right, that's a lot, and we're sitting at 81 cents right now. So I've been accumulating, dollar cost averaging all the way down. My average entry is like $1.30, just because I bought little pieces here and there and started, kind of progressing and upping my my amounts DCing on the way up. Not the smartest thing to do, but you know, I'm gonna be buying on the way down as well. I bought some at 83 cents. I'm probably gonna buy when it gets to, if it gets lower to 55, if it does go any lower. But I'm definitely gonna be accumulating more as time goes on, just to prepare myself. So that's a good one. I've heard good things about. Why can't I heard good things about AVAX. AVAX is a good potential one. Like I said, do your own research. I'm not an altcoin guy. I have one or two that I plan on getting into, and that's it. All right, let's go back to BTC real quick. So going back to what I was saying before, it's all about level by level movement. So if we continue to sustain below 58K, 60K, my personal opinion, and based on what I see off the charts, what the charts tell us, 50K is entirely within reason. And if that fails, you know, anywhere from 50K to what the previous top is here around 49K, 38K is absolutely in the cards. And then we just got to take it level by level. So as for now, I'm not going to go too crazy about trying to figure out exactly what price is going to do. But the next logical step is 50,000. So let's go ahead and look at other coins here. Where's ETH? I do have ETH here somewhere. Let's see. I know LA87 said he got the ABC on ETH, right? Now, did you buy spot? Is there? I want to see how. Oh wow! And the Coinbase chart, it did really good. Okay. On the Bybit chart, it looks a bit different, but I see exactly what you're talking about. Okay. Wow. Yeah. So ETH has a very similar setup: A to a B to a C with an ABC within the C. That's a textbook setup. With ETH, based on my experience, I don't know what your stop loss is. If you are using leverage, just let me know if you're using leverage or not. I would personally structure my trade setup like this. I like 5% on ETH, 4.5 to 5%. I mean, even if you get, let's do 4.5. You want to be a little more aggressive. All right, that's almost a 10 risk to reward. Just getting back to the previous high. If you want to go to all-time high, yeah, it's a 15 R&R. That's a really good trade. So that's personally how I would do it, because that looks like a very nice continuation setup. Like I said, the last time this happened, a correction like this level happened, was back here. So very good potential continuation setup here. Oh, I need to sneeze. Okay. So, okay, you are using leverage. Yeah, just keep in mind, give yourself a little bit of breathing room with ETH and some other alts. I know a BTC, I like to be a little, even still, 3%, 4% is not aggressive. All right, so let's see, what else are we looking at? When was this put in? Oh, this was a couple weeks ago. Okay, never mind. If you check the ETH, BTC pair, you can see that ETH is about to move. Oh, yeah. Look at that. We talked about this. Yep. You're absolutely right. Potential move coming for ETH BTC. Same thing with KDA. KDA's got a really nice ABC setup on the ETH BTC chart, which I don't personally like to trade this, but that's a good indication. Good possible indication. How's the volume, guys? Should I lower it, raise it? How's the music volume? Should be good. Maybe alt season incoming. Yeah, could possibly be. That's why I've been accumulating. You never know. Let's see how ADA is doing. ADA, not really doing much. Kind of a similar situation to KDA. LTC, not really doing too much. Whoa, did Matic really retrace that much? Wow. Hold on. Okay. That's what I thought. In the grand scheme of things, it's not that bad. If you guys have any questions or anything, let me know. I know it's been a while since I've been back, so I'm not expecting too many people. My apologies for that. James Baker, very weak bull run. Who said it's over? Remember, in major bull runs, you have to have pullbacks. I don't understand where this notion that we just go up in a straight line comes from. If anything, if we do pull back and we find support and we continue to blast off, that is considerably. I'm going to change the word. That is exponentially more evidence, or it gives me a little bit more confidence for sure that we're in a much larger bull run, much bigger bull run. To go up in an exact straight line to me, it's just not the right time. It's not the right time. Remember, I talked about this on multiple occasions before the halving. The Bitcoin bull run doesn't actually take off or happen usually until like 3 to 6 months after the halving. So it's probably not going to be till like the beginning of end of summer, beginning of fall until we start actually blasting off. So we can consolidate range forever. We can come back down, test supports. And remember, it's like price is like a rubber band. Let me find one. All right. You give price basically the ability to flex, pull back. You see how the tension grows, and if I release it, it's a much stronger launch. It's the exact same thing. Price needs to come back, give itself time to find supports, give it that potential. I wouldn't say. Let me change that a little bit. I would say you need price to come back down, retest supports, make sure it's confident, make sure it knows that it wants to find support and build the strength to continue it to the upside. You can't do that by just going up in a straight line. What's your opinion on the traditionals? That's a good question. I know. Okay, that was like 9-10%. I'm like, so look at the SPY. To me, the traditionals are still very bullish. All right, we are above all-time highs. All right, we can just come back down, kind of retest this region as support, and then continue the upside. That's a more bullish case scenario. If we come back down, start sustaining lower lows below that previous pivot, right? That is a different story. Then we can talk about a potential more bearish outcome or bearish price action going forward. I wouldn't say. I always talk about this. Right, the last time we put in a larger ABC was back during the 2008 recession. Right. Do I think it's going to be on the same scale? No. But if we do come up, kind of fake out, get back below, it's just like BTC. We have to look at previous areas of support, right? We found support around the $400 region for the S&P. And then if it continues to fall below that, you're looking at around 345, 350, or 346, whatever that local low is. Or 348. 348. Let's call it 348. But if 348 fails, I mean, like I said, it's a level by level scenario. That's going to be a major, major recession. If that is the case, then nothing is safe. To call BTC a safe haven asset now, I don't think is the right move. Even gold, I personally, even though gold's on a run right now, all right, back in 2008 when the recession happened, it didn't really outperform everything that, I mean, okay, let me change that. 187% for gold is huge. I will say that. So maybe gold and silver is the move. I know I have some silver assets. I might accumulate more. Who knows? Let's see. Let's go to the Dow Jones. Same thing with the Dow Jones, right? We're above of the bullish pivot, right? Or sorry, we're above the bearish ABC. So as long as we sustain, if we come back down, we can always come back down, retest supports, right? But if we continue to sustain lower lows and breach and maintain below that previous bearish pivot, right, off of this ABC, that's not good. That is not good. So right now, like I said, overall, I think pullbacks are healthy. Pullbacks are fine. We have to just wait and see how if price gets down in that region, how it's going to react. DXY. Okay, I talked about this on previous streams before. This can kind of tell us maybe what's going on. All right, we have a couple different outcomes for the DXY. All right, we have an ABC here, which means we do have an A. Now, either this was the B, we're going to get one more high for the B, and then a continuation lower. All right, so remember, the DXY and assets are inverse correlated. So if the DXY is going to go up, assets usually go down. Vice versa. The value of the dollar goes down, assets go up. So that's a possibility. Another possible outcome is that maybe this is it. Maybe this is all we get. Right? And maybe we're on our way up to like an A to a B to a C. Maybe do something like this. A, B, C for an A. Maybe come back down, retest for a B, for a C. And we continue higher. That's also possible. All we have to do is mark out the levels, weigh how price reacts, understand the different outcomes of what could be going on, what the next possible move is. And then from there, we can get a better idea once price reacts off of the levels that we're looking for. And we can get an idea of what's coming up next. Obviously, you can't. I mean, you could trade a DXY. I'm not a big fan of that. But yeah. So we have to wait till we see how the DXY reacts once we get above 107. If we come back up, push through, we just keep going up. 114 is the next step. And if 114 is the next step, I don't know. That's a not so good for assets. Mr. Reckless, how you doing, my friend? It's good to see you. How you doing? Long time no see. I know. I apologize. I got sick last week. And I'm like, I just got better. I wouldn't say just got better, but I'm in good for a few days now. And kind of get myself back in the routine of things. I had really bad strep throat. My voice is, I still feel like it's at 100%. So I could barely talk. Like I completely lost my voice. So it made no sense for me to stream. Luckily at the time, nothing was really happening. But now that, price is getting a little bit more exciting, I'm glad I'm here to talk about it. And we'll see. I'm not in any trades. I might consider, these are going to be DCA points for me. At some point, if we do come back below, if we do test 50K, we put in some sort of ABC here, I'll consider taking that. Hold on a second. I need to change screens for a second. I'm still here, though. There's something in my eye, and it's bothering the shit out of me. I don't want you guys to see me digging around. Okay. Or maybe this might be easier. There you go. I'm back. Ta-da. It's like a magic trick. All right, let's see. I think I read over everything. Yeah. Let's see. Go back to level by level case scenario. Price is pumping right now. Maybe this is all we get. Who knows? We could come up, kind of retest areas of resistance and then reject further. Who knows? I really don't know. But for me, that bullish setup is not. All right. The bullish setup is for this pivot here. Potentially this pivot if you want to. If you want to play the smaller APC, you can. Just tread lightly. Like 3.5%, somewhere around there. Target that, maybe higher. That's the next bullish move, or bullish position I would take. Yeah, I looked at everything. We have 40 minutes. Okay. Yeah, we're just going to hang out for a little bit. I don't want to make this stream too long just because I have stuff to do. What's going on with Forex? I haven't touched it. I haven't touched Forex in months. I mean, we could take a look at. Yeah, I just haven't touched it. I don't know if I mean, maybe I might go back to it. I just haven't had the urge to. I just have so much going on, like personal life and stuff, and my hours. That's another reason why I haven't streamed as well. Is my sleep schedule has been so messed up and going to bed super late, waking up super late. But today was like the first day I woke up at a reasonable time, so just haven't had the time to. Yeah. So you guys have any questions or anything? What's going on? How you guys doing in your personal lives? FOMC today? No shot. Is it going on right now? Wait, is the drone? Oh, it is. Oh shit. Did I miss it? Oh, okay. All right, I guess we'll stick around for this. He's gonna speak in 20 minutes. Oh shit. All right, so we're gonna maybe change the title of this too. Let me change the title. We're gonna hang out and watch FOMC. You know what? Let's do that. I haven't done that in a while. I'll keep. Sound gold. Oh God. Studflation. 500x BTC short. God, these live chats are crazy. I'm trying to get. There we go. This is what I was trying to do. There you go. So now when I click around, it's not going to mess. It's not going to minimize. Looks like. Why does he look like the penguin a little bit? That bow tie. Do you have a Discord? I do have a Discord. It is a paid group. You can message me privately though if you want. My DMs are always open. Yeah, I'll post it in. What the fuck? Like I said, I have my own Discord, but like my own Discord group, but I haven't been as active as I used to be. There's a lot of good that Discord is primarily meant for like information. Like I have a whole bunch of tutorial videos on it. I have a whole bunch of updates that I get. I give updates whenever I find something in the market that I'm going to trade or take positions on. But the actual Discord is mostly meant for just it's an information hub. Does this? I mean. Every time I try to paste, how do I add a friend? Johnny, when are you getting married? I don't know, my friend. I have no idea. Marriage is an interesting topic of conversation. Me personally, I think you can get married to someone without having the state involved. I just don't like... All right, here's my username. If you want to message me on Discord, you can message me. But yeah, no, marriage for me, like, I believe you can love someone, you can fall in love, you can commit to someone without having the state involved. If you're very religious, which, you know, I personally am not, Um, oh, I got rid of the thing. Of course, L87. Yeah, I personally don't think you don't have to you have to involve the state in order to get married. Um, Marriage as a man, especially, is a when the state's involved. You know, you can get married in a church if you want and not get the state involved. That's fine. Um, but I don't know. I don't believe that. I just in my family, like my parents still together. Love them to death. They're doing great. Um, like I had a conversation with my aunt fairly recently, like over the holidays. Um, and she's been married, divorced, like 4 times, I think, 3 times that I know of. The fourth time, they didn't get married; they just stayed together. Um, but you know, married and separated 3 or 4 separate times, and she, for some reason, wants me and my girlfriend to get married, and she said the craziest thing. She basically said, well, you know, you guys should just get married. And, you know, if things don't work out, you just get divorced. Like, she just said it so nonchalantly. Like, yeah, it might be easy for you to say that. But as a man in the especially if you're in the United States, I don't know how marriage laws are in other countries, but if you're a man in the United States, marriage is not your friend. Marriage is a contract that, if that contract is broken, if you don't have the right things in check, you don't have the right plan, you don't have prenups, you don't have different agreements going up, you're gonna get absolutely shafted. And I have a lot to lose. You know, some people may not have that much to lose, where they can just go their separate ways, and that's fine. But if you have a lot to lose, getting married is, unless the other person is willing to sign contracts, agreements, saying that, hey, you're not gonna clean house, it just doesn't make sense to me. It really doesn't. And my girlfriend's on the same page as me, so she agrees that you don't necessarily have to get married through the state in order to, you know, stay monogamous, stay with each other, love each other. You don't need to have the state involved for that. So that's my marriage rant. Yes, and especially, you know, as a man, there's no rush. There's no rush. James Baker, thank you for thank you for asking a question that's not crypto related. I do appreciate it. When is Jerome Powell going to speak? 10 minutes. 10 minutes. I'm on the same boat with you. Yeah. Like I said, if you really, guys, there's nothing wrong getting married. Like, you guys can get married, do whatever you want, but you should understand the risk involved with anything. If you can't get yourself into any situation without knowing the risk about anything, then you shouldn't necessarily do it. It could be with anything. It could be with jobs. It could be with marriage. It could be with life in general. There's a risk to everything. What's the risk to reward on this? If you're severely in love, and like, I'm not saying I'm not severely in love, but like, I think the most important thing is understanding what you have to lose as a man. And for me, like, I don't have a steady, high-paying job to go to every day. I chose a route in life that, luckily, because of me being smart, me being risky, being aggressive, I was able to achieve certain things, and now I have a lot to lose. So for me, this doesn't make sense to. Sky Knight, yes, I'm here. I'm alive and thrive. I'm alive. What was I think of another way to put this. I can't think of it. Surviving and thriving. We'll go with that for now. Let's see. Can you see BTC more to the downside? Absolutely, Jan. Absolutely. Remember, I'll try to fit this in frame. Remember, we are below a major support level. All right, it's a level by level scenario. If price cannot sustain back above 59K, we're going to 50,000. There is nothing holding us back. Like, this is a straight shot up. And when price basically goes up in a straight line, it can go down in a straight line just as fast. So just keep in mind that as long as we're below, which we're below this area of support, there's nothing stopping us from testing 50K. And if we break 50K, we're probably going to, we still have that 49K region over here off of this high. Make sure you guys can see it. Yeah. Off of this high up here. But besides that, 38K is next. So we can absolutely see more downside. Surviving and thriving. But yeah, Jan, I hope that answered that question. Divorce can be a nightmare nowadays for men. Yeah, and I know, like, I have close friends of mine. I've met people throughout the years that like working different jobs and stuff, and it's not to the same severity, but it's almost the same story all around. Like, you marry a woman of your dreams, you marry a high school crush, you marry someone that you've known for a very long time. You guys think you can live together forever. And then something happens, something goes wrong. A lot of the times it's a money situation. Divorce happens, the wife ends up leaving them, and she can easily take half your stuff, no problem. The court system is very favored against men. I don't care what people say. Like, I go by what the stats show. Right. I think it's like 75%, something ridiculous. I think it's like over a majority of marriages will end up getting divorced. I forgot the exact percentage. I know it's above 50% though. I don't want to say it's something crazy like 75, 80%. It could be. I don't quote me on that though, but there's stats out there showing. On one of the major regions, it's fit. I think over 50% of marriages end in divorce. Then 80% of those divorces are initiated by women. Something like that. I know that, and the majority of why they divorce is because of financial reasons. Guy lost his job. Maybe he's not doing as well. Maybe he's working on a performance-based job. He's not doing well. He's having bad months. A lot of things change when money's involved. So I know a friend who lives in a car because of it. Exactly. Like, I'm sure everyone here has a story of how, especially if you're in the US, of how divorce has ruined someone. So when it comes to marriage, guys, don't rush it. Focus on building yourself first. And once you focus on building yourself, the right person will come along. Right? Don't let age concern you, okay? I'm a lot better of a man I am now at almost 30 than I was at 21. And if you take care of yourself, which I know I haven't, but if you take care of yourself, you can find yourself a good job, or maybe you do well investing and you figure a way to secure your money, make something out of yourself, take care of yourself, physically, emotionally, monetarily, you'll be just fine. And that's another thing too. Kids. Yep. He's also, exactly. Yeah. Child support. All right, Jerome Powell should be speaking any minute now, so I'm going to pull it up. Start looking. Guys, I want a studio like this one day. This is going to happen. I want a studio where I can do my TA and have like this cool background and stuff. It's going to happen. I don't know how it's going to happen, but I'm going to make it happen. Where the heck is it? Oh, all right, guys, it's happening. Let me get the volume up. There we go. Here. Any plans for this summer? Not really. Like personal life stuff. I don't have any vacations planned. I might do some on vacation this year. I've been doing a lot of vacations every year, so I might take a break this year. I might, like I said, my personal life stuff. I might be buying a business soon. We've been talking back and forth. I just talked to the owner of the business not too long ago. Me and my buddy are going to be doing this together. That might be happening soon. I have a lot of stuff planned that necessarily isn't going to be summer, like vacation wise, but I have a lot of plans. I just plan on hanging out. I want to get back in shape this summer, so I'm in like starting the fast and stuff again. I've been trying to like kind of slowly starting to control what I eat. So hopefully we'll get that ball rolling soon. We start to, oh, I had not had this playing. Shit.
More pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year.
Can I make this louder?
However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks.
I'll tell you more about it.
Policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess. Is it?
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways, as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply-side distortions and demand-side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation, and that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in-housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
Green line.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said we.
So right now we are currently above
so we were more confident
of this low, which is good.
Moving sustainably.
I'd be a lot more confident if we can get above
our
that green
confidence
line.
in that didn't increase in the first quarter, and in fact, what really happened was we came to the view.
You guys
that
are
it would
going to take
longer
this
get
on
that
leverage.
confidence. And
Just be careful.
I think there are. I think it's the economy has
Give
been
yourself,
very
as soon as
hard
you cross
for
above that green
forecasters
line, give yourself
broadly
some
to
breathing
predict, to predict its
3.5%,
path, but
4%.
there
Don't
are
try to
paths
take. Don't try to super scout
not
this.
cutting, and there are paths
Right?
to cutting. It's
This
really
is
going
a
to depend on the
potential
data.
range low.
In terms of the
You can target at
employment
least
mandate,
the high, if not higher,
to your
if you want to
point,
hold it. This
if
is
you
a
go back
really
a
good
couple of
continuation
years,
setup. I might buy.
our sort of
I might DC into some
framework
alts right
document
now.
says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the, times how far it is from the goal. And that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become, we're now focusing, the other goal, the employment goal, now comes back in to focus. And so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael Key.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%,
Sky and I did not.
That would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, you know, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions
you can tell he's just a little,
in any
sniffy.
way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, you know, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but you know, in the longer run, if you have wage increases running higher than productivity would warrant, and then you know there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. You were Nancy. Nancy, sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data?
He's got to be careful what he says, too.
And how confident are you that
I think he knows
rents
that
will be helpful on the inflation
he has
front
to watch
in the
what he
coming
says
months?
during these meetings.
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets, at least, have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we will be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group of branded people. Frankly, more diverse than it used to be in many dimensions. More diverse from the obvious, gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
There she is. Look at nice, peaceful, calming ending music to this. All right, let's go ahead and wrap things up here. I'm sorry. Bring that down. There you go. So yeah, you can see the market is reacting accordingly. Now, the one thing that does kind of confirm this a little bit for me is that we came back up and rejected off. So we turned this into a kind of support to resistance flip. So this, I know it's a small one, but here's an example. So if we do not reclaim, get pushed back above here, I think this kind of further solidifies 50K. Yeah, just keep that in mind. Watch out for that previous pivot of the A here on 59,000. Obviously, it's nice that we're not above it anymore, but if we can get back above that previous support area or if we can get back above that previous support area, that's good. If not, this is turning into a much larger potential resistance pivot. And if that is the case, 50K is absolutely in the cards. So let's go ahead. That's pretty much gonna, we're gonna wrap things up with that note. We're gonna play some Wordle, obviously. Can't forget Wordle. Got a nice buy order if BTC hits 50K and alts, and yeah, that's pretty much my plan, Sky Knight. I haven't been messing around with leverage too much, but I have plans to DCA. So I got buy order at 50K. I got some. When BTC hits 50K, I'm going to see where KDA and other alts are at. I'm going to sprinkle a little bit more, probably a couple $100 at a time, and yeah, just let it ride. So. Raise. Wow, we got 3 letters in one go. Oh, wow. DR. Diary. There we go. That was easy. Wow, Heather, you're so bad at this game. I figured it out before you. So yeah, that's pretty much going to do it for now. Yeah, you guys know the drill. We'll have to see what happens, but I think 50K is in the cards. And then, so yeah, I know it's the middle of the week. I might not be back unless something significant happens. If we flash crash to 50K by the end of this week, I'll be back. If not, I'm good on this time, guys. Next week, I will be back. I'm going to try to aim for the beginning of the week, like Monday, Tuesday. I will let you guys know. I'll do my best to kind of possibly schedule it ahead. If not, I'll let you guys know in the Discord if you guys are in the Discord. But just be on the lookout. Around the same time, 1 o'clock, Monday, Tuesday. But until then, yeah, let's go ahead and say goodbye. Heather, you're a loser. Sky Knight, Jan, L87, James Baker, Mr. Reckless, David, Oten. Anybody else is in here, I really do appreciate it. But yeah, be good, be safe, trade safe. Now you know the plan. Let's see how price reacts. Until next time, be good, be safe. Let's do the thing. Bye.